Good afternoon, everyone. We're glad you're here. Thank you for joining today's webinar, The U.S. Deficit, the Dollar, and Your Investments. Before we dive in, I'd like to mention a few housekeeping items. If you have questions during the presentation, please submit them using the Q&A feature that's located at the bottom of your screen. Your questions are only visible to our panelists, so that would be to me, Brooke, and Jack, so feel free to type in whatever is on your mind. You don't have to worry about others seeing it. We will aim to answer as many of your questions as possible during the Q&A portion of the presentation. Today's presentation will start with a brief commentary from our speaker, then more of a fireside chat format with Evans May Wealth partner Brooke May asking questions of Jack Janasiewicz, who you may recognize from appearances on Bloomberg TV and CNBC when also watching for Lizzie and Brooke. Now, I will turn it over to Brooke to introduce Jack.
Thank you, Emily. It's my pleasure to introduce our speaker today, Jack Janasiewicz, Chartered Financial Advisor who serves as Portfolio Manager and Lead Portfolio Strategist at Natixis Investment Manager Solutions. He's also the manager of the Loomis strategy that many of you hold in your portfolios. With over 25 years of experience in the industry, Jack's widely recognized as a thought leader on the economy and the markets. His commentary regularly appears on Bloomberg, Reuters, The Wall Street Journal, Financial Times, as well as mentioned before, Bloomberg TV, CNBC, and other major media outlets. Today, Jack will guide us through his thoughts on the U.S. deficit, the strength of the U.S. dollar, and specific economic pressures to watch, including AI, the government shutdown, tariffs, just to name a few. The goal is to connect these topics with the markets to discern how these may impact the investment strategies and your portfolio. With that said, please join me in welcoming Jack Janasiewicz.
All right, so I guess I'll make a couple of quick comments here to start us off. Thanks, Brooke, and again, thanks, Emily, for having me on. Just how we're seeing things over the next couple of quarters. Let's keep this very simple. Things I think are still pretty good, and in my conversations with clients over the last, let's call it 6 weeks or so, there certainly seems to be a fair amount of unease. I think that actually gives me confidence to feel like you don't have a lot of overly enthusiastic sentiment backdrop here. That's typically when we start to get a little bit concerned when investors are sort of very euphoric about the backdrop. And I would certainly say we're far from that. And there's plenty of things that we're worrying about, and I'm sure we'll talk about these concerns over the next couple of minutes in here. But if we step back and just think about the big picture takeaway for what we're seeing in the markets right now, it really comes down to earnings. And as we start to go into the heart of earnings season right now for the third quarter, I think we're still hearing the same sort of vibe that we've expected to hear, and that things are still in pretty good shape. And tying this back to that wall of worry that we've been talking about, a lot of concerns, for example, around the inflation backdrop and how that might start to eat into corporate profits. But yet here we are, earnings estimates continue to grind higher, and that rate of acceleration in those earnings estimates is actually picking up. We've also heard a lot of concerns about the potential impact from tariffs. And yet when we look at margins continue to expand. So again, a lot of the things that we're still worried about, we try to tie that back to the corporate earnings backdrop, because that really what matters for the equity markets here. That earnings backdrop still remains very, very resilient. And bring that back to a wider picture here with regard to the broader economy, you're looking at a Federal Reserve that is probably at least going to be easing, if not on pause, at least in the interim, but certainly not hiking interest rates. And as long as the Fed remains fairly accommodative, I think that's going to be another backdrop that remains very supportive for the economy. Maybe the last thing to hit on is the consumer. Again, consumption drives about 70% of the economic backdrop here in the United States through consumption. The consumer, while somewhat bifurcated, we're certainly seeing maybe some things getting squeezed at the lower income cohorts, but those upper income cohorts continue to still spend away. And that really drives the bulk of the consumption that we're seeing right now. And so as long as those upper income cohorts remain very supportive, and we're seeing that whether it be from job security or from the wealth effect, we're still seeing that spending continue to push its way through, and that remains very supportive. So putting all of these things together, I still think the backdrop's still pretty good in here. And as a result, things may be slowing at the margin, but we're slowing from a pretty elevated rate. That still puts us in some pretty good backdrops with regard to that earnings backdrop for corporate America. And as a result, we're still pretty optimistic for the coming quarters in here, and certainly expect to see the markets continuing to grind higher, especially into the end of the year and the beginning of next year. So, with that, maybe I'll flip it back over to Emily here, but we're still pretty optimistic on the backdrop for corporate earnings as well as for corporate America.
So you mentioned earnings, you mentioned the Fed, but what factor might be a surprise to the markets, positive or negative, in this coming year?
Yeah, and I think really the big one for the markets is simply going to be whether the Fed starts to actually move from at least easing or being on hold to the potential for an interest rate hike. And so to get an interest rate hike, we would certainly have to see inflation reaccelerating in here. But when we start to think about that inflation backdrop, there's a couple of things maybe that are worth highlighting. When we think about the inflation prospects and especially how the Fed thinks about it, it's really not just a few things that you hear about in the news. It's really a basket of goods and services. And what's interesting, the things that we sort of hear about on the news, really, and they're related to the potential from tariffs. Think of those as durable goods, for example. That represents roughly about 20% of that inflation basket. Yeah, we're certainly seeing the potential for a little bit of an uptick in prices there. But when you look at the other part of the basket, and we can really pick on things, something like shelter, and shelter is what we consider to be rents. We're actually seeing rents dropping. Those are about 20% of the index as well. So, you've got 20% potentially pushing higher from tariffs, 20% pushing lower from basically rents easing up. Those are basically offsetting each other. But we don't hear much about that sort of disinflationary impulse coming from the shelter component. We only hear about the goods impulse coming from the tariff side. But again, from the bigger picture that the Fed looks at, all these things are working together and it's sort of keeping that inflation kind of in the status quo, not really seeing it pushing higher, and a little bit of a bias maybe to push lower here. But the risk is that those basically start to come undone a bit and you start to see inflation pushing back up. And the risk then is that the Fed actually has to start hiking rates. Again, not our base case scenario, but I think for that optimistic outlook that I sort of outlined at the start, to see inflation picking back up, that's probably the key risk for us going forward.
Mm-hmm. Interesting. So we've had a great earnings season. What is your expectation, though, for earnings going into next year? Is it sustainable in this rate environment?
Yeah, that's going to be obviously the number one issue to start to think about. And, there's certainly a couple of themes that are continuing to sort of play itself out. One of those really being that AI investment theme, right? That CapEx theme, and certainly getting a lot of press more recently. And if we look at the amount of money that was spent during the second quarter, the contribution to GDP growth just from the AI investment through CapEx was almost a full quarter percentage point. So it was a big number. But if you think about it from an absolute perspective, we're not even talking about $500 billion in CapEx coming through. So the absolute number is still fairly small. It's just that how big did it grow in such a small window? That actually had a massive impact in terms of what happened with the economy. And obviously, one person's CapEx is going to filter into someone else's earnings. And that's sort of what we're seeing with regard to that backdrop. So anything related to that AI trade right now, especially tied to the CapEx trade, whether it be through semiconductor chips, whether it's the we're seeing some of this on the utility side for energy production, just from a pure infrastructure standpoint, building out these buildings. Anything that's related to that AI build out is really seeing a boost in their earnings per share expectations. And so, for our perspective, that third quarter earnings backdrop was very important because those hyperscalers, the Microsofts, the Googles, the Apples, the Metas, we wanted to see, are they still spending money? Because if they are, that means that CapEx trade is still alive and well. And I think we got confirmation of that last week that these hyperscalers are still spending. They actually upped their forward guidance for CapEx spend. And as a result, at least in the near term, it certainly feels like that AI trade is still alive and kicking, and that's going to continue to support earnings in the near term.
Yeah, AI has been quite the buzz and very instrumental in earnings. Changing the subject a little bit, valuations. Do you think that right now valuations are justified? I know we've seen great earnings growth, but the market is trading at 22 to 23 times forward earnings, which is expensive compared to historical averages.
Sure. And this is one of those things that we've talked about with clients for quite some time, that sort of proverbial wall of worry. And one of the things that always comes up really comes back to that earnings concern and the numbers you just quoted from a forward multiple standpoint. A couple of things I think that are worth highlighting when we start talking about earnings, though, and one of the things that I always like to say when we talk about, for example, price to earnings multiples, beauty's in the eye of the beholder, and sort of the same thing I think is with valuations, right? I like to say that a multiple or valuations are somewhat of an opinion. You might think something's expensive because it's trading at a forward multiple of 30 times. However, I might actually think it's trading cheap because there are things about that company that I might think are important to me that are worth paying up for. For example, maybe they're buying back a lot of stock. Maybe they have no debt. Maybe they have a wide moat business. And so as a result, those sort of things that I would prefer to own, I find attractive, and paying up 30 times might be worth it. So we kind of go back and forth on some of these arguments. And so it's sort of you're trying to guess what I'm saying is either expensive or cheap. And that's really, I think, a hard thing to do. I want to share a slide real quick here because I think it tells an interesting story when we start to think about things like, what are valuations used for. What you're looking at here is a simple scatter plot, okay? On the x-axis, you're just looking at the forward PE ratio for the S&P 500, and then on the vertical axis, you're looking at the 12-month return forward. And so you can sort of see here, it's just all over the place, right? You don't really have a sort of distinct pattern. And so the idea here is simply that says, over the next 12 months, the relationship between where that forward multiple is and the potential returns you're getting, there's really not a good, strong relationship there. So from a short-term perspective, it's not a good timing tool. And if anything, I would argue, if you're starting to use valuations as a market timing tool, maybe you're actually going to leave money on the table by moving out of the market, as opposed to if we get a correction and things sell off, what you protected yourself in, you might give up some. So from that perspective, it's a little bit trickier. But if you start to look out a little farther, and that's what you're doing with this chart here, you're just looking at the holding period and the relationship between forward multiples and those forward returns, you can sort of see the correlation really starts to grow as we move farther out. So when you're talking about, let's say, 10 to 12 years from now, that multiple does have an impact in terms of those forward return expectations. So near term, not really a good market timing tool. Longer term, though, and talking 10 years out, has a pretty good idea of saying, if you're buying something with a cheap multiple, you're probably going to get an above average return going farther out. So again, short term technicals, trading, not really good looking at multiples, but looking out 10 years plus, you get an idea of buying something that's cheap. You probably have a better return longer term, so to speak. So a little bit of a dynamic in between short and long term investment horizons.
And speaking of cheap, right now, international markets look cheap relative to the US. Do you see foreign outperforming the US? And if so, why or why not?
So one of the things that I've learned over my 25 years or so in investment, I think when I start to look at what my core holdings would be building a portfolio out, I really end up having a bias towards U.S. equities. And as I like to say, if I'm thinking about U.S. equities, I would want to marry U.S. equities, but maybe I'll date international and emerging markets. So there are times I think with a shorter term horizon where you might want to own international equities or emerging market equities, but I think longer term you still want to own U.S. and that's where you start to see the dynamics of the labor market. We have the ability to hire and fire people. It's a little bit more stringent when you start to go overseas, so that makes their economies a little less dynamic. And if I look at where the growth backdrop is today on a sector basis, right? What's exciting? Where are we seeing double-digit earnings estimates coming in consistently? It still comes from the tech sector. And when I think about the S&P 500, that tech sector, and we can define tech in all sorts of different ways, but you could potentially see somewhere between 30 and 40% of the S&P really being attributed to that tech segment of the marketplace. And that's where the growth is. If I look at something like Europe, you don't really have that sort of big allocation to those dynamic sectors. And so, as a result, I still see the longer term investment opportunities in the US because of the growth in the tech segments. The other thing I would point to, and you had mentioned, certainly we can make the argument that international equities might be cheap, but they're cheap for a reason. And that's because the sectors you don't want to own, things like real estate, things like staples, they're trading at a pretty significant discount in Europe, whereas the things you want to own, you want to own tech, you want to own industrials, you want to own banks. Those are actually trading very expensive. So when you kind of put them together, there's a little bit of an offset there. So, again, beauty's in the eye of the beholder. When we start to think about what's cheap and what's rich, the stuff you want to own in Europe is actually not trading quite as cheap as you think. It's the stuff you don't want to own that's dragging that headline number down. So we still have a longer term bias towards the US, just simply because to us it's still about tech. That's where the opportunities are, and that's where the growth is in earnings, and that's where I think it continues to be going forward.
If you had to identify one factor that's the single most understood factor in the markets right now, what would it be?
Ooh, that's a good one. Only because some of these factors like to come and go, right? Some of them will ebb and flow. For a while there, you could make the argument that momentum was a pretty big factor, and I think that was partly what we'd seen in, for example, in the run up with gold prices, for example. I know there's a fundamental case that is at the heart of some of the reasons why gold had moved up, but I think it got carried a little bit farther simply because of the momentum trade in there. So you could argue that the momentum factor is something that starts to play itself in. You could also argue back to quality, where quality is probably a more of a longer term perspective, and think of things that drive the quality factor. You're thinking about margins and you're thinking about return on equities. And so again, if I go back to sort of what we were just talking about with regard to US relative to Europe, when I look at those net margins, when I look at return on equities, U.S. equities have a very, very superior backdrop margins, almost 400% in an absolute percentage premium over what we're seeing coming out of Europe. Return on equity is closer to 600%. So again, when you think about that quality factor, the U.S. backdrop is far superior to what we're seeing around the world. That also lends itself to some of these longer term ideas. And so point being, some of these factors come and go. Depends what's in vogue, what's not. Quality tends to be a longer term perspective, and that tends to favor U.S. But as we've seen over the last couple of months here, that momentum factor can be very, very powerful.
Switching to tariffs, how have tariffs positively or negatively affected the U.S. economy and markets?
Yeah, this is interesting because I think when we started to go back to the wall of worry concerns, at the start of the year when we started to hear the tariff announcements coming through, there were certainly a lot of concerns about the potential ramifications passing through to corporate earnings. And what's interesting is we continue to look at net margins. Net margins are continuing to drift higher. And at this point, we're certainly well aware of the impacts from tariffs with regard to corporate profitability. And yet corporate America is still actually doing a pretty good job of managing this. So I think this speaks to the idea that, if you give corporate America the rules, they'll figure out how to make money. They'll figure out how to be profitable. They just need to know the rules. And so that's sort of that certainty backdrop that we talk about. But again, we're seeing signs of tariffs being shared, that burden. We are certainly seeing certain segments of the of imports prices are drifting up a little bit. Some of that is being shared by both the importer, by the wholesaler, and being passed on to the consumer. So, when we look at the average effective tariff rate, so we actually see the number of proceeds coming through from tariff collections being deposited at the Treasury, and we just divide that by the total number of imports. That's running at about 9%, right? And I know the headline number was certainly a lot higher than 9%, but that's what we call the effective tariff rate. So that effective tariff rate is certainly a lot lower than the headline rate. So again, maybe another reason why we may have overestimated the impacts from tariffs. And it's being spread across too from multiple areas. So the impact is certainly not all being passed on to the consumer. Some of it is, but it's being spread out. And that's certainly, I think, also helping to dilute some of the impacts. But maybe the one benefit to this is the government is raising some revenue, which at the end of the day will certainly help offset some of the deficit concerns in there. So it's a little bit of a mixed bag, but I think in general, corporate America has done a pretty good job dealing with this. And as a result, things are probably coming in better than expected because of that.
How would you expect tariffs to impact the strength or the weakness in the US dollar?
Off the bat, we certainly would have expected to see dollar strength with regard to any sort of a tariff announcement, because if you think about it from a foreign currency perspective, if I'm going to start charging, let's say Korea, for example, a 10% tariff, if the Korean won depreciates or drops in value versus the dollar by 10%, from our perspective as a home person here in the United States buying a export coming in from Korea, that currency adjustment would have already sort of offset the 10% tariff, right? You can put up prices by 10%, but if the currency drops by 10, that percentage that I'm actually spending in dollars to buy that good is offset, and I don't see that. So we would have expected to see, I think, the dollar strengthen relative to those foreign currencies that were being impacted by tariffs. And so we've seen a little bit of that. Maybe not quite as much as we had seen. I think you could probably make the argument that some of our neighbors to the north and south saw a little bit more of that adjustment going forward. But, I think what we've seen basically is really more of a growth differential issue there, right? Money's going to flow to where it's treated best. It's going to flow where the opportunities are. And more recently, we've seen a little bit of a bounce in the dollar. But if you take a step back here and think about what happened during COVID, right? The dollar rallied almost 30% relative to its trade-weighted peers. So giving some of that back in here, 10% or so, it's not really that far-fetched. And if you look at the bigger picture for the dollar, it's basically back in the middle of that range. And more recently, we've seen a little bit of strength. And I think that's largely a function of maybe the U.S. economy is doing a little better than everybody else, despite everything you're hearing with the headlines. And that's putting a little bit of pressure on the dollars. Assets really come back into the U.S. because they're seeing a better return on capital there.
Earlier, you touched on the Fed and inflation, but just to dive a little deeper, how would you assess the current performance of the Fed's dual mandate of price stability and full employment?
Yeah, this
Is stronger today.
Yeah, this is very important because, the Fed actually has, like you just mentioned, a dual mandate, right? They have two targets that they're trying to hit. It's price stability and full employment. And the balance of risks, so to speak, have been shifting over time. If you go back maybe about a year ago, a lot of the concern were more on the inflation front, not so much on full employment because the labor market was doing pretty well. If you sort of now go back to maybe the last couple of months, that balance of risks have shifted. We're certainly seeing a slowing in the labor market with inflation remaining somewhat sticky. But that shift has made, I think, a very important shift in the thoughts of where the pricing for future rate cuts could go. And the one thing that I thought was really interesting, Powell said this at his press conference last week, they had mentioned that their inflation readings were coming in around 2.3, 2.4%. And they estimated that core inflation, but they estimated that the impact from tariffs were about 30 or 40 basis points. And so they treat tariffs as a one-time price increase. And so if you think about that being a one-time price increase, inflation is a year-on-year rate of change. So once we get past 365 days, that base effect falls off, right? So if the Fed is saying it's a one-time price increase, but once we get to 366 days, that one-time increase is now gone from 365 days ago. So you'll see that big drop. And so when you think about that from an inflation perspective, if they see that as dropping off and they're arguing that tariffs are accounting for about 30 or 40 basis points on inflation and core PCEs running at about 2.3, 2.4, that means it's actually at 2%, which means it's at their target. And so from that perspective, that gives the Fed a little bit more room to say, hey, maybe we could spend a little bit more time focusing on the labor market, which has been showing some signs of softening. Now, the issue there is it's not terrible, but it's weakening. They're on alert for that. And I think that gives the Fed a little bit more room to maybe err on the side of cutting rates as opposed to not cutting rates at the December meeting. So the shift in their mandate is focused more on the labor side. We're seeing signs of it slowing. And I think that gives the Fed a little bit more room to say, you know what, we're going to focus a little bit more on that side of the equation as opposed to the inflation side. And as a result, my guess would be that we're probably higher probability that we see a cut in December than we don't see a cut.
Makes sense. Now let's talk about the U.S. debt and deficit. Markets have remained resilient despite rising debt levels. What explains the disconnect between the debt levels, government spending, and the stock market?
Yeah, and this is a tricky one because when we start to think about what drives sort of investor sentiment, that becomes, I think, the key in terms of how we're thinking about things. And one of the things you have to think about when we start talking about the deficit is if we treat the U.S. government like a corporate balance sheet. And I know everybody's making a big fuss over the potential of a 6 or 7% fiscal deficit. Really what it comes down to, though, is the willingness and the ability of us to be able to pay our obligations. And we can certainly make the argument that there are better things to spend our money on, rather than interest payments. But at the same time, we can still make those payments. And if you think about all the things we have, whether it's just US dollar reserves or it's oil, land, and again, we're treating it like a balance sheet. So what are all the assets on the US government's balance sheets? To be able to actually sell those things off to raise the money to then pay off our debt, we actually have a very strong balance sheet if you think about it like a corporate. A lot of people don't want to think of it that way. So, again, it comes back down to the bond investor, its willingness and ability to make those payments. The ability is there. I think the willingness is there because we understand how the financial systems operate. And so certainly, it's a concern, but is it an immediate concern? I don't think so. And the other thing I think people maybe don't appreciate, it's just how important treasuries are to the global financial system. The banking system has changed today so that if you want to actually go out and borrow from as a corporate perspective, our system is now based on collateral, and that collateral runs on treasuries. If I want to get a loan, I can go to you and you'll loan me $1 million, but I may have to give you $100,000 worth of treasuries as collateral. But you'll still get the loan because you're posting that collateral. Well, the most effective and efficient means of collateral in the banking system today, the way it's evolved, is treasuries, and more specifically, it's T-bills. And so there is this unrelenting demand for T-bills underneath the whole surface because if you want to get a loan from the bank, you need the collateral, you need T-bills, and as a result, that's where all this demand is coming from. So I think people don't appreciate that the financial system is actually requiring all these T-bills if you want to get a loan, and that's underpinning this natural demand that's out there for the bond market. The other thing to think about, if I'm a large institution and I want to basically put my money into something that's liquid and risk-free, there's not many places in the world you can do that, and the U.S. Treasury market is one of those places. And as a result, that's what we call it, exorbitant privilege, so to speak. That is one area that we still see it. And as a result, if you look at a lot of the data that we follow that shows who are the people that are coming in and buying treasuries, for example, foreigners are actually coming back into the U.S. market because A, it's liquid, it's very deep, and oh, by the way, you can still get a 4% yield, which is still pretty good in the relative scheme of things. And most people still are comfortable that the U.S. is going to pay them back. So we hear a lot of the concerns about the deficit. Certainly is something that we can't continue to sort of ignore. But having said that, I don't think we're at the point where we're going to see the treasury market just suddenly blow out because everybody's worried about financing. It's something that we've known for quite some time. The bond market's certainly not waking up tomorrow and saying, oh, we have a deficit of 6%, I better sell off. We've known this for a while. So the market's already well aware of this, and it's actually doing fine. At the end of the day, what drives bond markets? It's going to be economics, right? It's going to be inflation and growth. If inflation goes up and growth goes down, the bond market's going to sell off. If it goes the other way, inflation comes down and growth remains resilient, bond market's going to do okay. And any sort of concern about a recession, you're actually going to see the bond market rally. So at the end of the day, it's still going to be driven by fundamentals near term, and those fundamentals are still in pretty good shape.
Is there a risk, though, that the ongoing deficits eventually would weaken the dollar's reserve currency status? Or is that
I mean, I can appreciate that, but I think, again, going back to sort of how the global financial system is wired, the U.S. dollar is really the backbone to the system. And, if you think about, and if I can remember the stats off the top of my head, the amount of dollar debt that's been issued in the world is almost close to $100 trillion. Now, again, dollar debt, so we're talking about corporates, sovereigns, quasi-sovereigns. You have corporates overseas that might be in Europe that are going to issue in dollars because they want to hit that pocket of liquidity. So, you have almost $100 trillion that are being issued in debt. People need dollars to basically transact this sort of thing. If I look at global trade invoicing, something close to 80% of all global trade invoices are denominated in dollars. The list goes on and on here. If I look at SWIFT payments, so SWIFT is basically the system, online system that puts banking directions out there. It tells which banks, which accounts need to be credited and debited so cross-border flows can go back and forth. Those are roughly all done. About 60% of all SWIFT transactions are done in US dollars. The next largest currency, it's euros at around 20. So, you're seeing dollar usage almost 3 times the next most liquid currency, which is in euros. And you always hear about the potential for the Chinese renminbi to be used. Well, we're talking about less than 1% of global financial transactions are taking place in renminbi. So the point, dollars are embedded in the global financial system. And so for that to be sort of unseated as the currency of the world, I'm probably going to be long gone by the time that starts to happen. It's just so embedded, it's so intertwined in the financial system, it's not going to be easy to get rid of. At the margin, we might see a little bit of it shifting somewhere else, but there's just too many things that operate in dollars. So as a result, I have a really hard time seeing the US dollar being dethroned as the world's reserve currency.
Now let's pivot to consumer sentiment. How do you interpret the current readings of consumer sentiment in the context of employment, inflation, and savings?
Yeah, and I've got a chart here I'm going to pull up because I think this actually tells a pretty good story here. We actually started to no longer pay attention to some of the data that's been coming out from these surveys. You can see here, this is the University of Michigan survey. And what's interesting, they ask all sorts of questions in the UMich survey, but this one was basically asking, how do you feel about your expectations going out for the next 6 to 12 months? And then what's your political affiliation? And you can sort of see there's a very, very wide divergence between those who are responding that are claiming to be Republicans relative to Democrats. And you can sort of see these have flipped over time. And so basically what it's telling me is that if your guy is in office, you're optimistic. But if your guy isn't in office, you're pessimistic. And so the point I want to make here is that some of these surveys are really being tainted by the political backdrop. And so that doesn't really necessarily give me the confidence to read through and think about this from a pure economic perspective. So some of these things are certainly being tainted from a perspective of the political biases. But here's the other one that I love to show. Here are sort of a lot of the ideas that consumer sentiment is souring, but this is just a chart of weekly flows coming into equity products, whether it be ETF or mutual funds. And if there's such a dour sentiment out there that you sort of hear from some of these surveys, investors are certainly not reacting to that. They keep piling money into the stock market. And so what I like to say is, pay attention not to what they're saying, pay attention to what these consumers are doing. And so in this case, they're putting money back into the stock market. But if I also pulled up some of the numbers that show consumption, retail sales, those are still pretty resilient. So you can say one thing, but you're going ahead and doing another. And so pay attention to what people are doing, not what they're saying, because what they're doing doesn't match what they're saying, and what they're doing it reflects a much more optimistic backdrop than maybe what they're saying from a sentiment perspective.
Oh, that's so true. Another topic that's on everyone's mind, the government shutdown.
Yeah.
What do you believe are the potential effects of the economy if the shutdown drags on for months?
Yeah, so the shutdown, I think, will be a temporary disruption in the economy. A lot of this doesn't necessarily go away. It'll actually be recouped. So, government employees will get back pay, so they'll be made whole in some cases. The government, when they're doling out the contracts to continue to run the government as a business, those contracts are certainly going to be flipped back on once we get back through the shutdown. So you're going to get an air pocket in terms of economic growth, so to speak. But you're going to have a catch-up period when we sort of get past this whole thing. So you're not going to get a ton of lost growth potential, so to speak, as the shutdown rolls on. And I would certainly say that I would be hard-pressed if we don't see the government shutdown ending before, I would certainly say the week of Thanksgiving, because when you start to get America traveling for the holidays, you're going to start to hear it and see it, and that's going to reflect pretty poorly on Congress in general. So, I think you're probably going to get a resolution over the next couple of weeks. And if the other one too is some of the adjustments on the healthcare side with some of the premiums that are going out, that I think started today. So you'll start to see some of that kicking in as well. So there are certainly, I think, reasons for why the political rhetoric might sort of start to feel the heat from the public, because the public's going to start to really feel the adverse impacts from the shutdown, I think, starting this week going forward. So I wouldn't be shocked if this thing gets done over the next 2 weeks and we're back to business.
And once the government does reopen, do you think it'll be a snapback scenario to the economy, or something that'll take some time to kind of recoup?
Yeah, I think you might see it slowly come. I mean, you'll certainly see a bump up, but it certainly won't all come back at once. So my guess would be, over the next quarter or two, you'll start to see that catch up. But again, I want to stress that it's not lost potential. It's just pushed out, and you'll be recouping the bulk of that over the next quarter or two.
Strength of the dollar. How do you assess the current strength of the dollar in a global macro context? Rates, trade, geopolitics.
I think the issues there are, from a fundamental perspective, usually there are two things that are going to drive currencies, and somewhat they're interrelated, right? It's going to be interest rate differentials. So if I can earn a higher rate in another country, capital tends to flow wherever that higher rate might, wherever that might be. So in this case, when I look at, for example, interest rates in the U.S. relative to Europe, the Fed fund rate, sitting at just inside of 4. ECB's deposit rate at 2, that's a pretty big differential. So that would lean in favor of assets flowing into the dollar to recognize that interest rate differential. The other one is going to be growth prospects, right? Because if you just assume that the GDP growth backdrop is a proxy for earnings growth, or at least the direction of earnings growth, if you have an expanding economy and growth is superior to another region, you're probably going to have better earnings and better potential returns on capital. And money's going to flow where it's treated best, and that's where it's going to be in terms of that return and return expectations. So, again, I go back to the interest rates in the US, although they're coming down, still a little bit higher than the rest of the world, but also that growth backdrop is still much in favor of the US. And as a result, I think that's going to at least put a little bit of upward pressure on the US dollar. So, I think there's some concerns about the geopolitical backdrop, but I think the growth prospects of the US economy are enough to at least offset that. So maybe worst case is the dollar sort of trades range bound over the next couple of quarters.
The last topic I have on my agenda before we switch to questions from the audience, midterm elections and the market impact. How do you expect the upcoming U.S. midterm elections to affect the market sentiment and equity flows?
Yeah, we're going to get a couple of, you've got some of the mayoral races coming up soon. That I know a couple of people have been talking about that as being a potential harbinger of what we might see for the midterms coming up. You also have some of the redistricting stuff that'll slowly start to work its way through. We'll have to see where that plays out. Excuse me, but I think traditionally speaking, when you go back and look historically, Congress has always flipped, and so when you have, in this case, the Republicans holding both the House and the Senate, the odds are in favor, historically speaking, that something flips there, and they no longer have the advantage. I was talking to the girl that works for us down in D.C. about this, and I think we both sort of are in agreement that it's still likely that we get a potential of a flip of one or both, but the odds of them not flipping are maybe higher than the market is expecting right now. So a little bit of a nuanced response there. Historically things flip, but maybe the market's a little bit ahead of itself, and we're thinking that maybe the odds of things not flipping and staying status quo might be a little bit higher than what's being appreciated by the markets at this point. And so economic ramifications for that, again, I would certainly point to the idea of the run up to the midterms. I'd be hard pressed to sort of see any sort of significant slowdown, at least not during trying to be somewhat supportive somehow from a fiscal side from the Trump administration. So, perversely, maybe we actually have a little bit of fiscal support as they try to support the market as we head into election season. And as a result, maybe that puts a little bit of a floor underneath growth. And so, maybe that downside risk because of that backdrop might be a little bit protected in here. And so any sort of pullback that's, healthy, maybe you're supposed to be buying those dips going forward.
Does Natixis have a year-end price target or a 2026 price target for the S&P 500?
We do not, but I will say the way I like to think about it and the way my team thinks about this is kind of ordinarily ranking it and then put a direction on that. And I will certainly say the direction is up. We've been pretty aggressive over the last couple of years in calling for double-digit returns. I think maybe we'll temper that, but I certainly think that we would still continue to have a positive year for 2026 going forward. So again, thinking between now and the end of the year, we're still thinking we close 2025 at all-time highs, and I don't see why we don't continue to have a pretty good 2026 either. Because again, what really ruins a pretty good economic backdrop and a stock market backdrop, it's when the Fed starts to hike. And again, based on the things that we sort of talked about here, any sort of Fed increase is just a low probability event from our seats at this point. And so from that perspective, the liquidity backdrop, the financial conditions backdrop, the Fed, they all remain fairly supportive. And I think if you get any sort of market slowdown in the labor market, that just means the Fed probably ends up cutting rates even more aggressively. And again, that's going to be supportive. So the backdrop, I think, still carries over into 2026. Not going to be a straight line up. I wish it was, make my job a lot easier. But, I think at the end of the day, the trajectory is certainly up, not down. And I know people are very, very concerned about all-time highs. You go back and you look, if you invest at all-time highs, it's actually better. It's one of the best times to be investing because you typically go on to make more all-time highs. People don't think about it that way, but that's really, if you look at the numbers, that's what happens.
Yeah, absolutely. Don't fight the Fed and don't fight the tape.
Bingo. Better. I like it.
The next question I have here, what would you tell investors that are nervous from headlines, social media, et cetera? And would you consider changing your allocation, for example, increasing bonds if you are nervous?
So my one advice would be to turn off your TV, get off of social media, go out and enjoy the world. I think listen, media sells bad news. That's what gets clicks. And unfortunately, things are still pretty good despite what you might be hearing and seeing on the TV, the radio, whatever you're reading on social media. And that's one of the hardest things, I think. And I'm sure you guys can sympathize. I feel like half the time we're more playing a psychiatrist here, trying to talk people off the ledge, do a lot of hand holding, and things are not as bad as they seem. They're not as bad as what you're hearing on the TV. So, I think from the perspective of risk management, though, everybody's risk tolerances are different. And I think, at the bottom line here is it's how much risk can you stomach? And, it's probably worth a conversation with, advisors like yourself, map things out. Here's where you need to be. And to get there, these are the things we need to do. And basically stay the course because, again, the more times you're out of the market, you're not earning anything. And as a result, trying to time the market and time these sort of pullbacks, I've been doing this almost 30 years. My hit rate on calling, 10%, 5 and 10% corrections in the market's pretty bad, but I'm pretty good at calling recessions, and recessions only come around, once every 10 years or so. And, again, I don't see the writing on the wall for a recession anytime soon. So, it's time in the market. You can make some tweaks at the end of the day, but, I think it's all about that, the goal that you're set, the risk tolerances you've talked about it. You can stay the course here because that's what's going to get you to meet those end goals that you're trying to get to.
I couldn't agree more. Next question. Where are you seeing opportunities outside the traditional U.S. large cap space?
Yeah, that one's a tricky one. I think when we think about, the potential for maybe some near-term trades, we talked a little bit about sort of, I date international and emerging markets, but I want to marry U.S. We are seeing a little bit more interest in potential near-term trades for emerging markets. And again, when I think about emerging markets, it really comes back to a couple of things there, but it's really a function of that tech trade again, because if you think about the constituents within emerging markets and their indices, they still actually have a fairly good amount of allocations toward that tech backdrop. And so where do we see the growth? And I walked through the whole backdrop, tech. Well, emerging markets has some tech to it as well. So I think we have a preference for having emerging markets over international. We still think U.S. is the better place to be allocated, but we have an overweight in the portfolios I manage to the U.S. equities. We actually have an overweight to emerging and an underweight to international developed, and it's largely, again, where do we see the opportunity? Well, that opportunity is still in the tech trade. Emerging markets has a derivative of the tech trade to it, so we think there's something there as well. And again, a lot of these emerging market central banks are going to be following the lead of what the Fed is doing. So if we think the Fed is going to continue to ease, and which we do, we still think you get a cut in December and then 2 next year. It probably means central banks in emerging markets are going to be cutting rates as well, which would be supportive of their backdrops as well. So again, that's more of a short-term trade, but longer-term horizons, it's still U.S. equities and still large caps.
Next question, kind of looping back to tariffs here. Will tariffs directly pay down our national debt?
Oh, I wish it would. I wish it were that easy, but no. The run rate right now, and I don't have the number off the top of my head, but I want to say the run rate is probably still going to be coming in lower than $1 trillion for the full year. As I said earlier, the Treasury actually publishes the receipts that they're getting in from tariff collection, so we can see it. It's about a week delayed, and so what we do is we take a 30-day window and then just multiply it by 12, so you get an annual number. That's still running well below $1 trillion, and so it certainly will help at the margin. Is it enough to completely pay down the deficit, or at least cover the debt, or cover the fiscal deficit? No, we'll still be running it. And so, again, the issue there is, some of the numbers that had been thrown out for how much we would collect, we're not going to even come close to those numbers. So, unfortunately, we still won't get enough.
The last question I have: any concerns around private credit headlines?
Oh, good one here. So this is a tricky one. Let me see if I can answer this as cleanly as I can. So some of the things that we have seen over the last couple of weeks regarding private credit to us has really been very idiosyncratic. And I know maybe that's a harbinger of doom and gloom because, well, that's how all these things start. They start as idiosyncratic, and then all of a sudden, I think it was Jamie Dimon's comment about the cockroaches. Well, when there's one cockroach, there's usually more. Again, this is one issue, idiosyncratic. Are there more coming? So, there's a couple things that I would point to, and without naming names, but the two, I think, underlying themes that we're seeing from those headlines that are coming out of private credit. One has been outright fraud, right? I mean, you're just people who were actually, collateral were given out twice. You can't do that. They're lying on some of the loans, that sort of thing. That's outright fraud. I would still consider that to be idiosyncratic. But the other one was really auto lending, and related to subprime auto, which means you're lending to really the most credit unhinged, credit impeded portion of the income class. So it's not surprising that coming out of COVID, when people needed cars because you couldn't buy a car, you had to buy a used car, so you went out and got used car financing, and rates were still elevated at that point. So again, you put all these things together, elevated car prices, I got to take a bigger loan out. The loan that I'm taking out has a higher interest rate, and all of a sudden now I can't afford to keep paying that. So you can kind of see how these things get into a little bit of a ball of trouble here, but it's a very specific segment of the market that we're seeing that's getting hit by this sort of thing. And what's interesting, again, going back to the earnings season, the big money centers always start off earnings season. And what's interesting, when you heard JP Morgan, you heard Citi, you heard Goldman, you hear all these big banks that are coming out and talking about what are they seeing with regard to the consumer. They all are saying the same thing, and that's their consumers' spending continues to be in line with historicals. They're very robust. Net charge-offs, they're not seeing any sort of uptick in charge-offs. They're not seeing an uptick in delinquency. So the big money center lenders are saying the consumer's in pretty good shape. So again, the point I want to make here is that if this is a more systemic issue coming from private credit, I'm looking at other areas where I might see same sort of red flags going up, and we're not seeing that yet. And again, I'm paying attention to some of the private credit equities. They get hit pretty hard, but they're now coming back again. So the mosaic of what we're seeing coming from private credit really is still pointing to it being idiosyncratic and not a systemic wide issue. And the other thing I would also point to, for a lot of these private credit issues, a lot of these guys, because they're sort of diversifying off some of these positions to multiple lenders, it's not huge positions on one book. Some of these things you're talking for $40-50 million. These are still pretty small chunks that can be easily written down. Yeah, some of them have gotten a little bit bigger, but the point being is, that's one small slice of these loan books for a lot of these lenders, and as a result, if they're running a diversified business with a pretty good margin, and that's what they're supposed to be doing, the interest carry that they're earning on some of the stuff is more than going to offset the losses they're taking. So again, good headlines. I just don't, at least right now, the stuff that we pay attention to does not signify this as being a systemic issue, more of a one-off. And so as a result, we're not getting overly concerned that this is something to all of a sudden panic about. Certainly, we're going to pay attention, but what we're seeing right now, it still looks like it's really idiosyncratic as opposed to systemic risk.
Right. Well, I can't thank you enough for joining us today, and I appreciate Natixis and their partnership and support. I found your insights very, very great, very interesting, and I'm sure our clients did as well. So thank you for your time, and thank you for sharing with us your guidance. We greatly appreciate it.
Thank you very much for having me. Appreciate it, Brooke.